February 28th, 2026. The United States and Israel launched military strikes on Iran. The Strait of Hormuz, the corridor through which 20% of the world's oil flows, was closed. Oil prices exploded. Inflation fears returned. Markets went into panic. And gold. Gold fell 17%, its worst drop since 1983 during a war. For generations, investors have lived by one simple rule. When the world is in crisis, buy gold. War breaks out, gold rises. Recession hits, gold rises. It is called the safe haven. But in 2026, the rule broke. The world's most important oil route, a narrow passage through which nearly a fifth of global oil flows. And now, it was under threat. And oil markets knew what came next. And that threat was enough to shake the entire financial system, triggering a chain reaction across the global economy. Oil surged, inflation fears returned, and markets began to panic. The dollar climbed, bond yields rose, and gold came under pressure. Then came the margin calls. Investors needed cash, so they sold gold first. In every major panic before this, there was only one refugee left standing: gold. But this time, the structure of safety itself changed. Because US government bonds started offering real returns again. For the first time in years, safe wasn't just safe. It was profitable. Bonds now paid over 4%, while gold produced nothing. And capital behaves simply in casa. It follows yield. So money didn't rush into gold, it moved into bonds instead. The fear was the same, but the situation was different. People were still rushing to safety, but now they had more than one place to go. What used to be an obvious escape was no longer the only option. And in that moment, gold was not the strongest choice. In moments of global panic, liquidity becomes the real priority. And when pressure rises across markets, the system naturally moves toward the safest settlement asset. Over time, this shift reflects in relative strength. One side gains steady demand, while others begin to lose momentum. And during the same period, this imbalance becomes even more visible. One asset strengthens while the other quietly weakens. Before that shift becomes clear, capital starts shifting quietly. When global liquidity tightens, financial behavior changes at every level. Markets, institutions, and debt flows all respond to the need for stability in settlement. It is not only about rates, not only about bonds. In moments like these, the world ultimately moves toward dollars. These moves are not random, they follow a repeating pattern. In every major shock, first reaction is always the same. Liquidity tightens and positioning changes instantly. Because in stress conditions, liquid assets are sold first to raise cash. But the second phase is different. When liquidity returns, capital moves back into risk assets. And gold benefits from that shift. So the system is not random. It runs in two clear phases, one driven by fear, the other by liquidity. And when liquidity tightens again, the market moves back into phase one conditions. In this phase, fear leads the flow of money and capital moves first to safety. Now you have the full picture. Next time a crisis breaks out, before you make any decision, stop and ask yourself three things. Because oil drives inflation, and inflation decides what central banks do next. Because elevated rates make gold the weakest option in the room. If all three answers are yes, the same chain begins again. Dollar strengthens, liquidity tightens, gold falls first. But that fall is not the end of the story. It is the beginning of the next opportunity. Because once the chain reverses, most people buy gold when fear is loudest. That is already too late. The smartest money moves before the headlines catch up. Understanding that difference is what separates the crowd from smart money.